Apollo is a vice president at Dimensional Funds. Dimensional Funds is a investment management company that we use that manages 500 billion plus in assets under management. And that's a B, 500 billion. Apollo is a nationally and internationally recognized speaker. He's delivered hundreds of lectures and seminars to not only financial professionals, but individual investors. I've seen him half dozen times and he kills it every single time I see him. He is considered the secretary of explaining stuff. We need to work on that. I don't know. That's because he really does excel at delivering thought-provoking presentations clearly and understandably. Paul has been with Dimensional for 16 years. He's taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara. Also holds a BA in economics with from Michigan State University, where he competed and coached water polo. Rumor has it that he is still an avid water polo player, and he did admit to me today that he did do a little surfing today. So so hopefully he's still got some stamina for us. So Apollo, welcome to our town meeting. I really appreciate you joining us.
Well, hi, Mark. Thank you so much for having us, and thanks to everybody for taking the time. And yeah, I wish I can still play water polo, but it's it's not the safest of sports, not really easy to wear a mask. And that's when I'm trying surfing. I'm an old guy. I'm over 50, and I'm trying to learn. It's the first summer that I've done it, so it's super fun. And it's our skiing. If we lived in Vail or Aspen, we'd be on the slopes every day, and this is our mountain in a way.
So for those who don't know, Apollo, where do you live?
I live in West Los Angeles, in Westwood, close to UCLA. Our offices are in Santa Monica, and before this I was in Santa Barbara, and so I the last 25 years or so I've been in Southern California.
So you've been
before then, Michigan. Michigan's my other place. Okay,
so let's go ahead and get started, Apollo. So the number one question on everybody's mind is the election. Okay, it was pre-election, now it's post-election. It looks like Joe Biden is going to be our president, unless some very strange thing happens. It also looks like we could be looking towards a divided government, with the Democrats holding the House of Representatives, the Republicans holding the Senate, although there's a special election in January, two of them actually. And so if you could do me a favor and do our audience a favor, can you give us some observations on how you think, who knows what's going to play out, but how this uncertainty and hopefully certainty at some point will affect us with both a divided government, or if there is a blue wave and the Democrats take, all three branches of, the Senate, the House of Rep, and the presidency.
Right. And, this election is the gift that keeps on giving because, we're weeks after and we're still kind of in this limbo. But let me start with just a general observation that the last few years, they have been different. And I think that politics in general touches on our deeply held beliefs and our identity and core values. And because of that, it tends to be very, very emotional. So for not just the last few weeks, but the last few months and even the last few years, it has been extremely emotional. And there's nothing wrong with feeling emotions, because that's what makes us human beings. And that's understandable. And it's absolutely fine. I think the question is, whenever we are in a state of heightened emotional sentiment, the decisions that we make might not always be in our best interest. And when it comes to managing money and investing, it certainly seems to be that case. So much evidence to show that there's a big behavioral component to investing. And the reason I'm bringing this up is because politics being so emotional, it is impacting us in the way we feel. And if you're on the winning side of an election, you tend to feel optimistic about the economy and the market. If you're not on the winning side, it's normal to feel pessimistic. And roughly half the country right now is optimistic and roughly half is pessimistic. At least it's better than a few weeks ago when everybody was in limbo and everybody had more uncertainty. So what I'm saying is that the way you feel right now, it's understandable and it's fine, whether you're optimistic or pessimistic about where we're going from here. What I'd like to suggest is that what Mark and I and we're trying to do, our teams, is acknowledge these emotions, validate them, at the same time disentangle them from investment decisions and make sure that when we make moves with your money, they're not based on how we feel, but rather on much more pragmatic reasons like data, analysis, evidence, research, and root the decisions in something that is more analytical and pragmatic than how we feel. So that's kind of where I like to start. Is anything that I'll talk about when it comes to election is not to make you feel good or bad about the choice you've made or where we're going as a country. It's much more around this idea that right now we need to look at the data and see if there's anything that we should be doing because of this election outcome. So I'm going to start with a bit of the punchline and then try to explain where it came from. And a bit of the punchline is this, that when we looked at this from an analytical perspective, what we see is that typically the presidents don't have as much control over the market and what the market does as the narrative suggests out there. So it's this narrative that whether you look at Congress or you look at the presidency, politics in DC in general seems to somehow move the market and drive the market. When you look at the data, it doesn't appear to be that way. Politics is a variable for sure, but it is not the variable. It is not the one thing that makes the market go up and down as much as we like to believe that. It would give us a sense of control, but that's not what happens when you look at the numbers. And I would say that the president has less control over the market. I think the market has probably more control over the president if you look at the data. So what I'm suggesting is that as you think about the election and politics, it does not impact the market as much as you like to think, but rather it's one of the many, many variables that impact the performance of the market as a whole or individual companies, individual stocks. And we see this over and over in the data. And let's try to start with just some numbers they're kind of easy to see this to begin with. I'm born in 1969, so I'm 51 years old. And when I was born, President Nixon was in office. And for the 5 years or so that President Nixon was in office, the stock market on average in the US, the S&P 500 being the way that we measure the market, actually dropped by about 2.9%, by about 3% per year during the 5 years or so that he was president. So certainly not a stellar result. And for the next 2 or 3 years, when President Ford came along, it skyrocketed at about 20%. If you fast forward and you look at the average annualized returns per year during the time in office for all these presidents, the one thing that becomes quite apparent is that there is no discernible pattern to tell you that having a Republican or a Democrat is better or worse for the markets. It's just not in the data. It just doesn't appear to be there. And more so, I would actually go a step further, and I would say a president should receive neither credit nor blame for what the market did while they were in office. Take President Nixon. We talked about him. Well, President Nixon was there, and before he even got in the White House, there was a move to transition from the gold standard to the type of currency we have today. He had nothing to do with that, but it happened while he was in office, and he was quite disruptive. Then there was the crisis in the Middle East that led to the OPEC oil embargo and the devastating crisis of 73, 74. Should he be blamed for the fact that the market tanked while he was in office? Not at all. President George W. Bush, he walked in the White House just as the dot-com was starting to go bust, something that he had nothing to do with, and it lasted for a while. 9/11 happened 9 months into his term, and he walked off at the bottom of the financial crisis. So should he look and say, wow, he was good for the markets? There are a lot of things that happen way outside of the control of the president that drove the market. So to me, it's really important to at least acknowledge that it's not necessarily that the markets are driven by the president. And more so, you look on the positive side, and you had President Bill Clinton. He was in office when Amazon and Google and these tech giants were formed, and he had nothing to do with that. It just happened to be while he was in office, and the market did remarkably well. So should he be credited for that? Again, it's hard to make an argument that a president should receive credit or blame because there's so many other big things that might drive the market performance during their time in office. And there's certainly there folks are saying out there saying, well, what about if you think of the policies that they enact? What about tax policy? Shouldn't that matter? And generally the policies. And certainly one of the narratives that exists out there is that if you have presidents who are focused on business and particularly tax cuts, well, that has to be good for the market and the economy. And we can look at some examples. If you think of President Ronald Reagan and the tax cuts that he not that he enacted, but the one that he suggested and the one that he put forth in the 80s, the market did really well during his time in office. A dollar invested at the beginning of this presidency, by the time he left the White House, it would have gone to $3.24. Which is a really nice result. It's a really good result, more than triple your money in less than, in about 8 years, not less than in 8 years. So really good results. Now, you also look at President George W. Bush, and for the 8 years that he was in office, a dollar invested at the beginning of his tenure, by the time he left the presidency, would have turned into 70 cents, even though they're not one, but two rounds of tax cuts, some specific towards investments like dividend rates and capital gain rates. So again, tax cuts, what it suggests is that they do not guarantee a successful market outcome. It could, but it doesn't have to be that way. And President Clinton, by the way, he actually had a tax increase and the market did better than both. But even if you have a president that comes in and let's say it has a more social agenda as a priority. And certainly President Obama came along and he's much more known for helping millions with healthcare and Obamacare rather than any business initiatives. A lot of folks were talking about, this is not good. We're electing somebody, and this was back in 2008 when people are concerned that his election is going to be a disaster for the stock market. And when you look at the results, a dollar invested at the beginning of his presidency, by the time he left the White House, would have turned into $3.28. And it's remarkably similar to the Reagan era. So whether you have a president who is really well known for tax cuts or somebody really well known for Obamacare, from a market perspective, it does not seem to have made a difference. It's pretty much the same. And that's what I'm cautioning people not to start kind of going on a path of saying, well, if the taxes go up, the markets are not going to do well. Or if we have somebody who's not super business oriented, the markets are going to do their things. And I wouldn't necessarily go there. Now, as we all know, it's not just the president, but also Congress that matter. And you mentioned the Congress, Mark. When you look at Congress and you extend this going back to 1920, since we have good data in the market, what you see is that the market, the trend of the market, this is a growth of the market since 1920s, and the only thing that becomes apparent is that there is a long-term reward for investors. That investors are rewarded over the long run by good market returns, irrespective of having Republicans or Democrats in Congress. There are long stretches when Democrats were in control of Congress, the blue waves here, and the market did really well. There are periods when the Republicans were in control and the market did well. But in neither case does it appear that it was a perfectly smooth ride. Here we had the 73, 74 downturn. Here we had the big tech bust. So to me, once again, it doesn't appear obvious at all that having Republicans, Democrats, or a mix is better or worse. The markets are going to be driven by a lot of variables that are bigger than what comes out of Washington. And you mentioned that the two seats left in the Senate up for grabs. Those are elections in Georgia coming up in January. And it's interesting because one of the possibilities is that the two seats could go to Democrats. And in that case, it seems like the Democrats would have control of the Senate, the White House, and the House. And that would be something that is typically known as a unified government. Unified doesn't mean that they're holding hands and singing Kumbaya. Unified means that these three branches, the White House, the Senate, and the House, are under the control of the same party. And we wanted to know what happens if you had Republican or Democrat unified control of government, and how much does it matter for the markets to get a sense if one party or the other is better or not. So in the case of the Republicans, they had this unified government control with the White House, the Senate, and the House. Over the period of 94 years that we have good data in the market, over this entire stretch, they've had this unified government control for 13 years. 13 out of the 94 years, they had unified government control. And what's interesting is that if you look at the average, of these 13 years, it turns out that the market went up by about 14.52%. So that's on the Republican side. Well, what about Democrats? Did they have unified government control? And it turns out that the Democrats as well had unified government control, that they controlled the White House, the Senate, and the House. And it turns out it wasn't for 13 years. It was actually a lot longer, 34 years. They had this unified government control. And during these 34 years of unified Democratic government control, the market actually went up. And it went up by 14.52%. We ran this number over and over. Multiple people did it. It is the actual number. Whether you had Republicans or Democrats, the market did the same. It was identical to the second decimal. That's how little it matters who is in control. That's not what you normally hear out there, but that's what the data shows you. Whether it's about presidents, whether it's about Congress, or whether it's about the unified government control, it doesn't seem that having a Republican or a Democrat is better or worse for our money, for your investments, for our investments. So because of that, I think it's important to step back and say, perhaps what comes out in 2021, what policies President Biden implements, whatever, perhaps we have seen this, and it should not form the basis of making a move with our money, because it doesn't matter. The market tends to be driven by politics in DC as much as we think. But to me, it has been a remarkable number. Almost stuck to 1452. It's quite stunning that it's identical to the second decimal. Anyway, so if you wanted to know by the third decimal who's ahead, I can tell you, but it's only by I think it's 0.001, and it's one party of that. I'm not going to tell you which one it is, but this is what the evidence shows. So when it comes ultimately down to it, why do we see this? Why is it that we have this? These results? Why is it that it matters so little who's in the White House? And there are 2 or 3 reasons that I think it's important to note. When we buy ownership in the market, we buy ownership in companies. We buy shares of ownership in Apple and Google and Qualcomm and all these companies that trade on the stock market. And the value of the ownership comes from the fact that the company makes profits. And that's what drives the value of an investment, because you're going to become part owner. Well, how much is that ownership worth? Well, it depends on what am I going to get paid? What profits does the company make? So if you think of a company like Apple, well, what do you think matters more? The products they have, the services, what the competition does, the strategy, how they execute it, what's going on in the world, or who's in the White House? Certainly that's a variable, but in the bigger scheme of things, those Apple profits or Google or Microsoft or McDonald's or Coca-Cola, they're not as driven as much as we think by who's in the White House. So that's the first thing, is that profits are not driven as much by policies from DC, but the company itself. Secondly, companies will find a way to make money in whatever state of the world it might be. Whatever might happen out there, whoever might be in office, these companies will find a way to make money. And I think a really good example, just to show that it's not even about politics. This year, coronavirus has been the devastating element. But if you think of Marriott has been taking it's a hotel chain, and they took a big hit because people were not traveling anymore. I used to travel every week. I don't do it anymore. So, these companies start losing a lot of money back in March, April, and it wasn't pretty. A lot of folks were saying, well, I'm not sure that how these companies are going to do it. Well, you have smart people running them. And guess what? As of a few weeks ago, Marriott is back to being profitable. That's what we're talking about. These companies will find a way to make money. They figured it out, that instead of renting rooms in hotels overnight. Most people don't want to stay overnight, but they wouldn't mind getting out of the house and working out of a different place, so people can rent Marriott hotels during the day and then go home at night. Anyway, the point being that companies will find a way to make money irrespective of who is in the White House. And it's a really important principle to understand. And the last one is that us as individuals, we tend to be, resilient. And as much as we're happy or unhappy about the result of an election, we don't really change our behaviors. Think about this. Are you eating fewer blueberries because you might not have had the candidate win? Are you buying more or less cereal? Is anything different in the way that you behave as a consumer, as an individual? No, we go to work, we do our thing, whether it's one president or another. So we are very resilient as individuals. And because we are resilient, companies are resilient, markets will be resilient as well. And that's what the source of optimism really comes from. In this free markets, in society that we live in this capitalist society, then the source of optimism is the fact that consumers are resilient, companies are resilient, and they will find a way to make it through whatever circumstance, higher taxes, lower taxes, so forth. The last few years, they had to deal with tariffs and trade wars, and you make it work. So that is ultimately, Mark, why I think that I'm very optimistic about 2021, what the future holds. And I don't think that this election, the outcome, or whatever policies might be coming from DC should form the basis of an investment decisions. There's just not enough evidence to suggest that you should do something with your money differently than what you already have in the financial plan.
Okay, so Paula, real quick, we have a question related to the 14.52.
Yes.
So someone had more a statement. They said, yeah, but the Democrats had many more years. And so can you clarify if that is an annualized 14.52?
No, that is just a simple, that's a good point. It's a simple average. It's a simple average. And you're absolutely right. And listen, the whole point of that is not to say that everything is perfectly, if you look at 13 out of the point being that whether you had Republicans in control, whatever period, whether you had Democrats in control, the market did not behave any differently. That's sort of the ultimate point. You're right. The Democrats had it, and you saw it on the chart that we had earlier, that the Democrats, had very, very long stretches of control of government. And again, from a market perspective, because I want to go back to this idea of market, from a market perspective, it didn't seem that the market tanked because the Democrats are in control. It didn't seem that they tanked the Republicans are in control, but rather there are other bigger things that happened, like we had the 73, 74 crisis or this. But you're right, it is not the same exact time period because as you see here, the Democrats had a longer control of Congress than did Republicans.
Okay, thanks for clarifying that. So also there's a disconnect as to our thinking who's in office and who's going to perform better. There's also a disconnect with this, and this is a question we get all the time: markets versus the economy. So here we are, we have millions of people, more people now that are still unemployed. We have a second round of shutdowns that's happening right now. We've had a year where the S&P 500 went down 34% top to bottom, and then I think it's back up 50% plus from the bottom. Right. Can you talk a little bit about that disconnect between the economy and stocks?
Yeah. No, it's a great question, and it's absolutely understandable why somebody would have that question. And I would start by suggesting there. I'm going to try to provide you a full answer to this question because there are two sides here. The first side is something that should be understood generally, that differentiates the stock market from the economy. And why is it that I would expect the two of them not to be in lockstep? So there's a very general response to why is it that the market is disconnected from the economy. It's not the first time, and it will happen in the past. So let's kind of set the stage of why this happens. But secondly, I want to be more specific to this pandemic period and what happened this year that in a way further amplified this disconnect. So let's start with the first one. Why do we see this? And to me, it became a little bit apparent that that the two of them are related, but they're not the same. In almost like I had this visual watching my 13-year-old daughter walk our dog. We have a little dog, and she was walking the dog, and she would go sometimes a little faster, sometimes a little slower, at a pretty steady pace, and that's what the economy tends to typically do. But the dog on the leash was all over the place. So eventually they got to the same point, but the dog with a lot more movement. So the dog obviously would be the market in this case. So why is it that there's so much movement, and why is it that they're related? They might get to the same place, but not exactly the same. Well, when you look at the economy, that tells you what's the economic output. How much are we producing as a country? It tells you how many people are unemployed. It tells you about the price levels. In other words, there are conditions pertaining to right now. What's the economic environment right now? That's what the economy basically means. The economic environment right now. So the economy pretty much impacts your paycheck right now, because your paycheck right now, to some degree, depends on what's going on in the economy right now. And that's what the economy is. The stock market, on the other hand, as I mentioned, allows you to buy ownership into companies. And the reason you got to become part owner is because you're going to get paid part of the cash flows and the profits that the company makes for years and years to come. So not just in 2020, but also 21, 22, 23, all these years down the road. In fact, one of the slides that was in the trivia deck that was run right before the webinar started was looking at Exxon. And Exxon has been paying back shareholders since 1882. That's over 100 years that you got paid as an investor in Exxon. So I think that's the fundamental difference between the economy and the stock market. The economy is about your paycheck right now. The stock market is your paycheck from the future. So the disconnect comes from the fact that the two of them have different time horizons. One is about now, the stock market's about the future. And because the stock market's about the future, it is something called forward looking. In other words, it has an expectation about what could happen, and it prices that in before it actually happens. You know, if you know there's a storm coming, well, you don't have to be there. You can kind of, make a move in advance, seeing that the storm is coming. Doesn't mean the storm is not coming, but you've kind of seen that, and you can do something in advance about it. And that's what the market's trying to do, is trying to really look ahead and look forward. And even if it sees economic pain, it also sees the light at the end of the tunnel. So to me, that's the fundamental difference between the economy and the market, is your paycheck right now versus your paycheck from the future. That difference in time horizons makes a huge, huge, huge difference. But what's going on right now? Why is it that today this is amplified to some degree? Well, one of the reasons that it's important to know is that the brunt of this economic pain has been borne by small businesses. We call the mom and pops, the main street shops. And whether it's in your neck of the woods and towards, San Diego, Orange County, LA, I drive on Main Street in Santa Monica, and I see all these shops that I used to go to, and they're not doing well. I can see that, and it breaks my heart. And it seems that they're taking the brunt of this. But what's been interesting is that these small shops, they are not part of the stock market. They're just too small to be part of the stock market. And us as consumers, what we've done is we've kind of changed our habits to some degree and moved more to the big e-commerce and the stock market companies. And they had deeper pockets, more resources, better power to negotiate. So in other words, what we're seeing here is that there's a difference between the main street, which are smaller businesses, took a big hit, versus some of the larger companies in the market, which might have been able to withstand this better. And I think that gives us a sense. Well, all these shops are closed, but somehow the market's doing well. It is a difference between these smaller companies, which are not part of the market. But the other very interesting thing is again, we talk about data, is to look at the market. And as you said, Mark, the market did very well this year. If you look through the end of September for the first 3 quarters of the year, the S&P 500 index is up about 6%, even with all those millions of people unemployed and the shutdown and all the things that we went through, which kind of makes you scratch your head and say, what's going on here? How can the market be up with all these bad things happening? Well, when you scratch beneath the surface, what you see is that the way that we measure the market, the S&P 500, is by looking at the largest 500 companies. And the larger the company, the bigger the impact, the bigger the proportion it has in this index. And the largest 5 stocks in the US market are the usual suspects: Apple, Amazon, Microsoft, Google, and Facebook. And on average, between the 5 of them, they were up a whopping 40%. 40% year to date through the end of September among these 5 stocks on average, which is a remarkable number. And when you look at their percentage, they're anywhere between 20 to 24% of the value of the index comes from these 5 names. 5 stocks amount to 20 to 24% of the value of the index. Now, what about the rest of the 400 or 95 or so companies that are in the S&P? How are they doing? Well, on average, the rest of the companies in the S&P are actually down for the year about 5%. So what is really telling me, Mark, is that when we look and we're saying, well, the market's doing so well, it might be an artifact of data. It might just be that you have these very large companies that have done so well. And in fact, because they're so big and they've done so well, they're lifting up everybody else. But it doesn't mean that every company is doing well. A lot of companies are still underwater. And to me, when we're saying the market's doing well, what is it, the market as a whole, or is it just the subset of giants that somehow have benefited, not nefariously, but they somehow were in the right place with the right products for this pandemic? So those are a few thoughts that I had on this idea of the disconnect. And perhaps when you look at it, it does start to make some sense that what we're seeing right now is not as divorced from reality as we might think at the first glance.
Okay, so since the stock market is forward-looking, Apollo, is that at what point, it looks like the FANG stocks or the top growth technology stocks are performing incredibly well compared to the rest of the market. At what point do valuations matter, and when do we see a snapback of the rest of the market?
Right. I mean, he asked a good question. I mean, what
crystal
do
ball
valuations matter? I mean, do valuations matter? Absolutely. What does a valuation basically mean? Valuation basically tells you that if you want to buy something, anything, it's not just the fact that you own it, but how much did you pay for it? How much did you pay to get it? And right now, some of these companies like an Amazon or others of these large companies, it's really nice to own them, but they are very, very expensive to own in some ways. Because if you look at how much does it cost to buy $1 of their book value, how much does it cost to buy $1 of their earnings, all these ratios, all these what's called valuations, they're quite high. And perhaps we'll come back to this in a second. How long can this last? Nobody really knows. But what we are interested in, and this is an interesting question that we've been getting for quite a while, is that when a company gets to be so large and dominant, do they continue to stay large and dominant? And we've looked at the largest top 10 stocks in the US market going back to the 1930s. And what we see is that there are some companies, the one with just a gray dot, like Time Warner here, they're only in there for 1 decade, and that's it. Altria, the cigarette maker, was also there for a decade. But if there's a colored dot around it, that means that that company was there for multiple decades. You take AT&T. It was the technology stock of its time. Telephony was such a big deal. And it was the largest stock for 40 years and in the top 4 for another 30. So altogether, 70 years. That's a long run of dominance, for sure, a long run of dominance. You had General Electric there for 90 years. Exxon was in the top 5 for the past 90 years or so, and including last year last decade when he was the largest company in the market. So certainly it doesn't, it's not unlikely, where I can't dismiss the idea that the tech giants of today will continue to be large and dominant into the future. It's quite possible that they might could do it. That there's evidence to suggest that, yeah, once you get to this size, you kind of lock yourself up. You're in the club, and you stay there. And there, look at all these companies here. Pretty much all of them are the same from decade to decade. So, is it possible? I would say it's possible. I can't tell you it's possible, not everyone, but it seems that it's likely that some of these companies at least will continue to be large and dominant going forward in 2021 and beyond. Now the question is that once you get to be so large and dominant, do you also, and by the way, this is not necessarily the right question because being large and dominant might be fine, but I think we ought to ask a different question. Will this company be large and dominant and also give me great investment returns? That's a different question. So you can be large and dominant, but are the returns that I get as an investor as good as I've seen so far? And we did look at this, and it's so interesting because when you look at these companies, 10 years. So this is the point where they get in the top 10 club. And if you backtrack 10 years, what you see is that they outperform the market. What this number shows you is the outperformance relative to what the stock market did. So let's say the return of the stock market was about 10%. Then these guys return about 20% on average for the 10 years before they got to be a top 10 stock. Over the previous 5 years, they outperformed by 19% and over 24% over 3 years. So what it shows you is that on the way to becoming a top 10 stock and climbing the mountain and getting on the peak, you really had remarkable returns. And that's exactly what we're seeing with these stocks, really high returns on the way of becoming a top 10 stock. And in fact, that's how you get there, with the price keep going up and up and up. The question is, once you get to be in that position, once you get to be a top 10 stock, will you also be able to deliver? Will these companies also deliver the same results to investor as they did before on the way up? And when you look at the evidence, what you see is that over the short run, they still outperform over 3 years, but by a lot less. It's only less than 1%. By the time you go to 5 years and by the time you go to 10 years, they start to actually underperform the market as a whole, the stock market as a whole. And so to me, what's interesting, it seems that they have great results, but once you get there on top, you can't really sustain the same performance, and that's what you see the performance going down for investors, not exactly what they saw in the years before they got to be a large dominant stock. And I think that intuitively you can see why this might be the case. I mean, the first one is how easy it is for Apple and Amazon and Google or Facebook, for that matter, to grow at the same click and sustain the same growth. It's unlikely. I mean, how easy is it for Amazon to double in size? You tell me, or Apple and so forth. But also, if they continue the growth that they've had over the previous 10 years, it's quite possible they might even be half this value of the entire stock market in these 5 stocks. But what we've seen in the past is that once you get to that point, it's not really easy to sustain the same returns to investors. Secondly, what I think it's important is that as an investor, you are rewarded based on the type of company that you invest. And once you become this large dominant company, you are mature. And in that case, you become something that's typically known as large growth. These are large, mature, well-established companies. They're well-run, but the cost of capital is different, because once you got to that point where you are so mature and stable, the cost of capital changes. And in order for investors to hold that stock, they'll be like, I'm going to be okay getting less because I have this mature company. And I think that's really important to note, is the cost of capital changes. In other words, if you think of somebody who has a stellar credit and a good job, well, the interest rate that they pay on their credit card or loans is actually lower than somebody who might not be as stable and mature. And to me, that's a little bit of what could happen. And the third point is that, if you are looking, it's great that we've had these companies. We had a great run, but we also want to capture the next great idea. And you cannot have the next Amazon by just holding Amazon. you have to diversify. And remember what, Gretzky said, which is one of my favorite quotes, is that what made me successful is that I tried to chase the puck not where it used to be, but where it's going next. So to me, the only way to do this is to diversify, is to not just hold these companies, which you should to a certain degree, but really diversify so you can capture the next Amazon, the next Apple, the next Google.
Okay, thanks for answering that. I appreciate that. Switching gears, yeah, another question that I fielded from clients, friends, everybody I talk to is, are we going to have massive inflation given all the debt, the stimulus? Well, it's truly extraordinary how much debt, and I truly believe that it did save the economy, but we still have all this debt to deal with long term. And so half the pundits say there's inflation, or maybe 60%. For, the other half says there's deflationary tendencies. What do you have to say on that?
Right. Well, I'm a big believer in market prices, so I'll tell you how you can use the market to get a sense of that. But also, I want to, really kind of go back a little bit and just talk about pure economics. This is pure economics. When you're thinking about inflation and where it comes from, because I've heard this question for the past 12 years. That's when, after the financial crisis, there was a program put in place called quantitative easing. And the quantitative easing program has been in there for a long time. And yet we have not seen any inflation, even though there was the expectation that we'll see inflation. And why is it that we didn't see it? And I think that from, looking at some economics, some basic economics, you get a sense of what happened. So what am I talking about? In the U.S. economy, there are three groups that generate economic activity. Consumers, the largest, about 2/3. This is what we buy. Businesses and companies buying things, and then the government. So what happened when this pandemic hit was the consumers and the companies, but particularly the consumers, the largest part, all of a sudden found themselves without a paycheck. Millions of people that don't have money anymore. So to the point that he made, when these consumers don't have money to spend, it's not only painful for the family, but it can actually really ripple through the economy. So let's say you have a family and the parents don't have a paycheck anymore, and they cannot buy their kids some pizza. It's not just the kids are suffering, but the pizza shop doesn't have enough revenue to pay rent, or the employees. They're not buying the flour from the farmers or the sausage. So it ripples throughout the economy, because then at that point that worker won't be able to go grocery shopping. The farmer doesn't sell their wheat, and they don't have money to spend. So what the stimulus really try to do is plug the hole and put a backstop to this snowball effect, and do it in a very forceful and timely way. That's what we learned after the financial crisis, that you need to put that backstop and plug in the hole quickly. Otherwise, it can really snowball and create a lot more economic misery, not just for the families, but also for the businesses, the small businesses, and also for the stock market. So in that respect, the stimulus did accomplish the goals that it was supposed to do. Now, the question is, well, wouldn't that lead to inflation, to the point that he made? Well, what's interesting about inflation is that it's not just about the money that the consumers or the government or the companies have, which is called the demand side, but there's also a very important piece called the supply side, which is what the economy can produce. Inflation basically means that you have too many dollars chasing not enough goods. That's what inflation fundamentally means. So let's make it real. So let's take this pen. If I am a pen manufacturer and I have a certain number of orders, and they come in and I fill my orders and I ship them out, everything's great. Now, all of a sudden, there's an influx of dollars, which is not necessarily the case in this time around, because stimulus is replacing income loss. But let's say there's an influx of dollars, like we had the quantitative easing. And then now at this point, people have more money, and I get more orders for my pens. Well, if my factory has the capacity to produce the additional pens, Well, I don't have to raise prices. I can just make more pens, ship them out. It's great. But if I reach capacity, then at some point I have to raise prices so some orders drop off and we can restore the balance. And I think that's the fundamental piece, is that inflation comes from two sides. One is the demand, but the other ones could be from the supply. And what we saw over the past 12 years is the economy as a whole had the capacity to produce and even surprised a lot of economists. And because of that, we did not see inflation. So if we were to see inflation, it's possible that it could come from too many dollars that consumers, the government, or companies have, but it could also come from the supply side because the economy just can't produce as much. So why would that be the case? Well, there are three things that come to mind. One is that a lot of companies still have protocols around coronavirus and what workers can do, how many people can be there. Second, we've had trade wars for the past few years, and these trade wars, just from reading business magazines and economists, they had an impact on the production. And thirdly, is that there are tariffs, and in some cases that could also have an impact. So to me, I'll give you an example. Not that anybody should feel bad for me. I try to get my 13-year-old into surfing, and for the past few months, I have been looking to buy her surfboard. And you go to all these websites that have foamies, which are these little beginner boards, and they're all sold out. And when you find them somewhere, the price is jacked up by 50%. Well, that's not because of the demand side. It's because when you talk to these shop owners, they say, well, I'm not sure where my next delivery is coming. There are all these routes. They're being disrupted by the trade wars. And I don't know exactly what's going to happen. So to me, inflation in this case did not come from the demand side, but on the supply side. And the supply side has nothing to do with the stimulus. It's just basically the ability of the economy to produce. So right now, again, you have to look at both of these. So if we have inflation, it could come from either the demand or the supply side. And right now, at least from what we're seeing, it's possible that the supply side might have something to do with it. Now, what does the market expect? Well, there is a metric out there. It's called the 5-year break-even rate, or the 10-year break-even rate. It basically tells you what the market participants expect inflation to be. And this is not an opinion that they state on a Zoom. These are billions of dollars that they're investing. In other words, they're voting with billions of dollars on what they expect inflation to be. And right now, the inflation over the next 5 or 10 years is expected to be about 1 to 2%, which is very, very similar to what we've seen in the past. Now, at the beginning of the pandemic, it actually dipped to a level that was called deflation, meaning that we didn't see prices rise. The expectation was that prices will not rise. In other words, there'll be too many goods chasing not enough dollars. But it didn't happen. And then once the stimulus got put in place, it kind of popped back up to the average that we've seen over the last 5 years or so. So in terms of the expectations, we are a big believer in market prices. And rather than telling my personal opinion, I can point you to the signals that we see right now in the way investors are deploying billions and billions and billions of their capital dollars.
So, Apollo, a lot of people out there have been sitting on some cash. Either they had a cash inflow, maybe they reduced their risk a little bit pre-election. How do you feel about deploying that cash right now? I think I know your answer, but and also what sectors or areas of the market do you think have them are the most attractive given the current status?
Yep. So it's an excellent question. So before we even get to what do I think you should do with your money, let's just set the stage, because we've talked a lot about stocks, which give you ownership in companies, and this ownership is rewarding. If you look at the stock market over the long run, the S&P 500. The annualized return has been somewhere in the order of 9 to 10% per year over the long run. But because it comes with fluctuating profits, it really it hasn't been the smoothest of rides. It's like almost like a ride at the Six Flags. So it's pretty choppy to be out there in the stock market, but it has been very rewarding to investors. My dad is 94, and he turned 94 a couple of months ago. And in fact, we have a book that it's the big encyclopedia of numbers. It's called the Matrix book. It's the best investment book that I've ever seen, that has pretty much all the data that you ever want, that you ever wanted about investing. And the good data in the US starts in 1926. That's when he was born. So if my grandparents had put $1 into the S&P 500 at the time when my dad was born, by the time he turned 93, that dollar would have grown to about $9,200. So it's a significant growth that you see in the stock market. So that's important to know, that the stock market has been a bit of the engine of growth for somebody's portfolio, but it came at the expense of a lot of choppiness. Profits fluctuate, so does the stock market. Nothing really unusual about that. But there's something else that you could be doing with your money. Instead of buying ownership, you could be lending your money to corporations and governments. There's a contract in place that specifies how much money you're going to get, what the interest rate you're going to get on that form of lending, for how long, and at the back end, you get your principal back. That's called a bond. And bonds behave differently because it's not ownership, it's lending. And because you have more certainty into what you'll be getting, let's say that if you lend your money to the US government for 30 days, that's called a 30-day US Treasury bill. Over the past 94 years, there has never been a single calendar year when an investor would have lost money. So a lot of stability coming from these bonds. And they also stayed ahead of inflation. The long-run inflation rate is about 3%. These bonds earned you something in the order of 3 to 4% per year. So to me, when you're asking what should you be doing with your money, I would say that the first thing that you ought to do is consider these two different asset classes, these two very different types of investments. And one gives you more stability, more preservation of capital. The other one gives you more growth. And to kind of see how big the difference is, if you take the exact same dollar over the same time period and you invest it in the safe treasury bills, the same dollar at 3-4% rather than 9-10% would grow to a whopping $22. $22, and that's it. No, no zeros missing there. That's basically it's a very big difference, but that's basically it. You're not making that much money in this stability of bonds. So the reason that I'm bringing all this up, because when somebody's asking me what should I be doing with the money in response to this, I would say that the first thing that you ought to do is go talk to Mark and the team, and make sure that you have a financial plan. Have an idea of why are you investing. When do you need the money? How much money do you need? What's your risk appetite? Do you have a pension or not? What's the comprehensive look at your wealth? And only after you do that and have this financial plan, then you can start making probably the most important decision, a key decision when it comes to investing, which is how much money do I put in stocks versus how much money do I put in bonds. So for me to tell you, it's election's over, go put some money because the S&P is going to run up, I think it's irresponsible, because I have no idea what your circumstances are. And for some of you out there, it might actually be better to have some portion of your money in bonds. And this has nothing to do with what's going to happen in the market, over the next year or 6 months or 2 years. It has to do with your personal circumstances. And that's why I think it's the most important thing in investing is to have a plan, to know what are you trying to accomplish? What's your risk capacity? And the only way to do this is to go and sit down with Mark and the team. So that to me is probably the one thing that I would do. Where's the opportunity? I think the opportunity is for you to get a financial plan and figure out, are you at the right level of risk in your portfolio? Are you either too safe or too aggressive, or is it balanced for what your needs are? So that's my first kind of comprehensive answer. I couldn't tell you go put money into one thing or another because I just don't know enough about your circumstances. And if anybody does that to you, I don't think it's a very responsible thing to do. Now, if you have a financial plan, I would really like you to go revisit it, make sure that you know what your balance of stocks and bonds is, because it's such a big, important decision. And if you don't have one, absolutely, make sure that you get one. The second thing that I would tell you is that the opportunity comes when things actually drop in value. So for example, let's say that you had a certain balance between stocks and bonds in your portfolio, and all of a sudden the stocks really went up. Well, at that point, the stocks are probably a bigger percentage of your portfolio than you'd like them to be. And vice versa is true. Stock market drops, and most people would look in panic and say, well, there's not doing good. Let me sell some stocks. What I'm suggesting is that when something drops and the price goes down, rather than treat it as like something that should be sold, rather than that, just think of it as an opportunity to buy at a better valuation, and to do it in a very systematic way that realigns the portfolio at the level that you desired. And that process is called rebalancing. That's what RSM Crum does on a very systematic basis. And they put in place a plan before it actually happens, and they execute it when there are these movements. But I think this is really important, because when something drops in value, I wouldn't look at it in panic. I just say, well, maybe is this an opportunity to buy? And right now, some of these stocks that I'm talking about, the large growth stocks, they are way up in terms of their, to a typical allocation. So at that, well, if you had a balanced allocation and these went up, then this might be a time to rebalance, take some chips off the table, and then go buy something with a better valuation. What could that be? Right now, for example, what you see in the market is the small companies. They are not up for the year, and also what's called value stocks, which are low priced stocks. They also are in a not flying high as these is tech companies. So my ultimate answer is that look at something that's done really well relative to other things, and maybe employ this systematic rebalancing process to take some profits and then reinvest them in something that is maybe below its desired percentage, and do it through the systematic process that RSM has, RS Crum.
Okay, Apollo, that was really well said. We're up against an hour. It went fast.
Oh, it went fast.
So I want to thank you for joining us. I want to thank our audience for joining us and staying with us. It looked like most people stayed with us the entire time, so I'm really happy about that. Again, if you have additional questions, reach out to your advisors. And Apollo, any parting shots, any thoughts that I mean, you covered a lot. I have a feeling that if I could ask you any question, you pull out your little pen and you could answer it, or you'd have a slide on it. So that was awesome.
Well, I mean, my thought is that listen, as much as we talked about the markets and the economy and money, and they're crucial things, I actually think that the most important thing right now is for you and your family and your community to get through this pandemic in a healthy and safe way, because ultimately that's probably the most important thing. Let's all of us get through this on the other end and be healthy and safe, not just ourselves, but our families and communities. So to me, I wish everybody to stay safe, and I also want to thank you, Mark, for inviting us to be part of this, and thanks for the trust that you placed in Dimensional, and thanks to all of you who are invested in Dimensional funds. It's really an honor, and we want to thank you for the trust that we placed. We've been hard at work through this pandemic. We're actively engaged in the market every day, and then trying to help advisors like Mark and RSM Crum really help achieve your financial goals. So thank you for the trust and the partnership. We really appreciate it.
Sure, absolutely, Paul. And thank you once again. Everybody, we're going to send out hopefully I hit the record button correctly. And if so, we'll be sending out a video replay within the next couple of days. So again, thanks for joining us. And Apollo, thank you again for everything you did. Appreciate it.
Great pleasure.
Have a good night, everyone.
Bye-bye.